So I've been investing for about 15 years, and I've done a lot of things right, but I've also done a lot of things wrong. And in those things that I've done wrong, I've learned a lot of lessons that I'm excited to be able to share with you today. Because just like one of my favorite sayings, sometimes you win, sometimes you learn. And I've learned a lot, so let me help you out. And real quick, on this channel, I do get a lot of beginners in investing. And so if you have been investing for a little while, kind of like me, and you've learned something that might help somebody out, go ahead and throw that down in the comment section and let's leave a library for those new beginners. I'm Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Number one on this list is that slowly but surely really does win. Sometimes it may not feel like you're doing enough. Sometimes it feels like, well, I don't have $200, $500 to put in every single week, or even every single month. And that's totally okay. Start with where you can start. If that's $10 a week or $25 a month or something like that, great, that's a great start. Remember that not only is that going to add up as far as the capital that you're putting in, it's also going to start gaining interest and compound interest on top of that. So just because you put in $500 in 6 months, which isn't a crazy amount, that doesn't mean that that's all you're gonna have. Hopefully that's going to have grown to maybe $550. And by the next year, maybe $600. And so every time that you put something in, it's growing and it's letting that money start working for you. Most people don't start in investing because they never think that they have enough to be investing. If that's you, I just want you to throw that thinking in the trash and get started with whatever you're comfortable with and get started today. The second lesson is out of sight, out of mind. The idea here is that psychologically, if we see money, if we see it in our bank account, we're probably gonna spend it. Or at least you think you have a safety net just in case you do spend that money, well, it was there in the first place. So for example, if you make $2,000 per month, but you automatically invest $200 at the beginning of the month or right when you get paid, then really what you're gonna see in your bank account is $1,800 per month. And pretty soon you're just going to make sure that you live within that $1,800. You're gonna totally forget that you were even making $2,000, and you're just gonna know now that that $1,800 is where you need to stay. And you'll know that I'm telling the truth because I'm sure that at this point you're making more money than you were 3 or 4 years ago. But if you're not investing any of that money and you're not saving any money, you've seen the opposite work. You're making more money now, but for some reason you're spending all of your money just like you were before. And that's because you see a certain amount of money and you psychologically think, well, that's how much I have to spend. So if you can do what others wisely call paying yourself first, and put that money into an investment account right away, then you won't be tempted. The third lesson is to stop listening to the media. Actually, literally stop listening to anyone. Hear them, understand their point of view, but don't literally listen and then make your investment choices based off of what other people are hyping or pulling down. It's the media's job to elicit fear, or at least elicit some type of emotion. You're not gonna watch it if everything's kind of okay. You're gonna watch if something's going crazy up or something going crazy down, and they're all about the ratings. Unfortunately, so are YouTubers and anything else in social media. So again, it's a good idea to hear what other people are saying and figure out what their point of view is and why they're even saying that, but make your own decision. Number 4, simple is the way to go. I personally may miss out on this huge score, but my life is good, and that's what I'm investing for anyway. I'm not investing so that I just strike it rich and make a crazy amount of money. If it happens, that would be amazing. I would definitely welcome that. But that's not necessarily the goal. I'm not even here for a dollar amount. I want to be able to live comfortably, have time freedom, and be able to give generously. And the way that I'm investing makes it so that those things happen. So when I say keep it simple, it's pretty much why I made this channel, and I like to just stick with a couple of ETFs that are super solid, then I don't have to do research on each individual company and stay up to date on all of these things. I like broad-based index funds and ETFs that track them, and I'm totally fine with a market average of 8 to 12% because it's beating inflation and it's doing what I'm looking for as far as why I'm investing my money. Which leads us to number 5, which kind of goes hand in hand with number 4, and that's to have goals for your investing accounts. You should really have goals for any accounts that you have, whether it be a high yield savings account, a regular savings account, an investment account, whatever. If you know what you're investing for or saving for, then it'll help you make better decisions. For me, all of my investing accounts are long term. By long term, I mean at least 5 years, if not more, but most of mine are 20, 30 years down the road. That helps me because if we have a bad year or something starts being a little rocky right now because of the economy, it doesn't make me freak out or do anything because I don't need the money right now. I'm not investing for the money right now, so I can just leave it there knowing that I can ride it out and let it come right back up like it always has. Number 6, an emergency fund could not be more crucial. This is a step that a lot of people skip over because it's not super fun, but it is so necessary. If you put all of your money into an investment account and you're there for the fun, you want it to go up a whole bunch. The problem is that at some point it may drop a whole bunch. And if at that exact time you're driving on the freeway and all 4 of your tires blow out and you have to spend $1,000 on tires or something, and the market is down, you're gonna have to sell some of your stocks at a loss, meaning you lost money, to be able to pay for those tires. If though you would have had $1,000 in your emergency fund and you have an emergency, you can just use that money to pay for the tires. Then you can keep that money in the market, in the stock market, as it's down and let it ride it out and come back up. Then if you want to sell it later on, at least you're selling for a profit and you don't lose money. Number 7, and this is a big one for me as both an academic or a professor and as a financial YouTuber, and this is that your friends and family probably are not going to listen to you. You're going to probably want them to be more financially sound than they even want to be, and you have to respect that. But let them watch how much stress gets taken from your life and how happy you eventually become because you don't have that financial burden. And eventually they're going to come to you and ask, and at that point you can lovingly help them out. Just like in anything else, you can only help people as much as they want to be helped. The 8th lesson that I've learned is that each investor needs to invest specifically for their specific needs. So you have goals and unique reasoning that's different than even me. So when I tell you what I'm investing in, I'm telling you this, but I always go into why I invest this way. Because I don't necessarily think that you should just invest in something that I'm investing in, but I do think you should hear why I thought this way or what my mindset was and why I picked that. I also try to talk about the other investments I have, like rental properties and some cryptocurrency, so that you understand that maybe I'm making super boring and safe ETF picks because I already have a bunch of risk in these other places. My hope for you is to be able to provide you with this whole holistic approach so that you can do the same thing and so that you can be successful for you individually. Number 9 is a little bit deep. It's a little bit of a hot take, but it's something that you definitely need to hear. The investment itself, the asset that you pick, is not necessarily going to be the reason why you get rich. For example, I see it all the time. People are on the fence. Should I pick this stock or this stock? This one is supposed to go up 10%, but this one might go up 11%. And not being sure which one to choose, usually you don't choose, and then you're keeping your money out of the market so it's not working for you. That little 1% that you could gain picking one or the other just is not worth it. For this lesson, the most important thing is that consistency is the key. Whether it's $50 per month or $50 per day, just making sure that you're consistently putting money into whatever investment that you've researched and that you believe in, that's the thing that's going to set you apart. Because at the end of the day, even if you were to get some crazy return like 20%, but you only have $1,000 in the market, that's going to get you about $200 in profit. If you were instead just consistent and diligent in putting $500 away every month for a year, and you put it in something boring like the S&P 500 that should appreciate about 10%, that $6,000 would have brought you $600 of profit. Again, consistency is key. Lesson number 10 is one that a lot of people will tell you to do, but they won't really tell you exactly how to carry it out. So lesson number 10 is all about make sure that you do not ever panic sell. It's a combination of one of the lessons from before and making sure that you do have a solid emergency fund, but then also making sure that you do crazy amount of ample research before you ever put money into any investment. I'm so confident in my investments because even if I saw my investing account go from $200,000 down to $150,000 or something like that, I wouldn't be worried because I understand not only the investment itself, but also the economy and just the way finances work. I understand market cycles and where we are in the market cycle, and I know all of this because I've done a crazy amount, hours and hours of research. On this channel, I try to start your research off for you and give you kind of the spark notes to get you started. but make sure that you're going through and doing a little bit deeper based on the things that I say. The best index fund, in my opinion, is the S&P 500, and within the next couple years, I think we're gonna see some astonishing numbers. I made my prediction of the price of the S&P 500 by 2030 in this video here, so go ahead and watch that and let me know what you think.